Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CA Final SFM, we are continuing with the topic international finance or Forex. This is the second lecture on Forex. In the previous class, if you recollect, we have talked about what is an exchange rate, what is a direct quote, what is an indirect quote, what is a two-way quote, how to convert a direct quote into an indirect quote or vice versa. Today in this class we will begin with concept number 7, that is spot rate and forward rate. So friends, when any bank or an exchange dealer, authorized dealer is placing a quote for currency, an exchange rate is being quoted, you would find that such exchange rate is quoted for making the transactions at the spot. So you approach any bank or authorized dealer, they would mention a list of foreign currency rates that they have quoted, and the rates mentioned over there with them are all spot rates. What is the meaning of spot rate? The rate applicable for buying and selling the currency at the spot. Now the spot rate within a day also would fluctuate. So the price that you agree with bank for a spot transaction has to be effected right then at spot. If you approach the bank after maybe even 2 hours, the rates might have changed. So bank cannot guarantee you that same rate will be offered even at later part of the day. That rate is not even applicable for the day, it is applicable at the spot, at that moment. So friends, in one line, if I have to define what is spot rate is the exchange rate which is quoted for buying and selling the currency at the spot. What about the other term, that is forward rate? Now the term forward rate, the word forward itself indicates something in future. That means it is a rate applicable for buying and selling currency not at the spot but in the future. But friends, you have to be specific while talking about forward rate. Forward rate is definitely a rate which will be applicable for buying and selling the currency at a future date, but not any future date. It has to be a specified future date, and the most important thing, that the rate has to be agreed today. So what I am trying to tell you is, a forward rate is a rate which is agreed today, but it will be applicable for buying and selling the currency at a later date or at a specified future date. So friends, whatever I have just mentioned, I'll summarize the same thing on screen. Please pay attention. So what we have just mentioned, that spot rate is the rate which is applicable for buying or selling currencies at the spot, and forward rate is the rate which is agreed today, but it is applicable for buying or selling currencies at a future specified date. So friends, what you find on screen need not be written. This is given in your textbook already. So let us move ahead with the next connecting concept, that is concept number 8, forward exchange contract. After understanding what is a forward rate, it will be simple for you to understand what could be a forward exchange contract. I approach a bank and request the bank that I would want to buy dollars, not today, after say 3 months from now. What would be the rate that you can negotiate with me? Let us agree upon a rate today. That means I am seeking a forward rate from the bank. Bank quotes a forward rate and I say, okay boss, done, let us enter into a contract. I would buy $10,000 from you at this given rate. Such contract with bank where I have agreed to buy dollars and bank has agreed to sell dollars at a specified rate. Rate is agreed today, but it is applicable for buying dollars after 3 months. I'll be buying dollars and bank is going to sell dollars to me. Then such a contract is known as a forward exchange contract. Now friends, in the foreign exchange risk management, the topic which we are going to discover ahead within Forex chapter, that is foreign exchange risk management. In that whole section, you will be learning various techniques for managing foreign exchange risk, and entering into a forward exchange contract would be a simple and straightforward way to manage the foreign exchange risk. Let me explain you how can you do that. In first order, I would say entering into a forward exchange contract gives you an opportunity to hedge your foreign exchange risk. I repeat, hedging your foreign exchange risk becomes a primary objective of such forward exchange contracts. So let me give you an example to clarify the situation. I just mentioned that I have entered into a contract with bank where I will be buying 10,000 US dollars after 3 months. Why would I buy 10,000 US dollar after 3 months? So let me elaborate the case. Suppose I have made an import of some goods from a dealer in the US. I have made import of goods and the invoice value is $10,000, US dollar 10,000. Now I am liable to pay this amount. The supplier has offered me a credit period of 3 months. Obviously, I will be benefited if I am delaying the payment. In simple words, if supplier has given me a 3-month credit, why not to use that credit? But what is the risk that I have? I have a risk of foreign exchange rate fluctuation. That means today the price of dollar could be something different, and after 3 months the price of dollar might change. So I would want to negotiate a rate with the bank. So to settle that liability of 10,000 US dollar, I have entered into a contract with bank where bank has agreed to sell 10,000 US dollars to me, say at a price of rupees 69 per US dollar. That means I have already negotiated a rate with the bank where bank has quoted rupees 69 per dollar, which will be applicable for me to buy $10,000 after 3 months. Then rupees 69 per dollar is the forward rate negotiated between me and bank, and the contract under which this rate has been negotiated is known as forward exchange contract. Now why this can be used for the purpose of hedging? Once I agree to buy $10,000 at a price of rupees 69 per dollar, then my outflow after 3 months is a definite amount of outflow in terms of Indian rupee. Why? Because irrespective of, I repeat, irrespective of the spot rate of US dollar prevailing then, I would buy dollars at the agreed price today. That means even though I am buying dollars after 3 months, but I will be buying at the rate that I have negotiated today, that is rupees 69 per dollar, irrespective of the rate of the dollar prevailing on that date. Isn't this giving me so much of security, so much of risk-free situation that no matter what happens in the forex market, I am not affected. I know I have to pay to the bank a defined amount and I'll be able to get 10,000 US dollar from the bank, which can be used to pay off my liability towards the supplier. So friends, whatever I have just mentioned, let me summarize the same thing on screen with this example, and please pay attention. So as we have discussed, a contract under which an entity has right as well as obligation to buy or sell currency at an agreed rate at a specified future date will be known as a forward exchange contract. A forward exchange contract can provide an opportunity to hedge foreign exchange risk. Thereafter, we have talked about an example. X Limited requires to pay $10,000 to its creditor after 3 months from now. The company enters into a contract with bank to buy $10,000 after 3 months at a contracted forward rate of rupees 69 per dollar. After 3 months from now, X Limited will settle this contract and buy $10,000 at rupees 69 per dollar, irrespective of the price of dollar prevailing on that date. Now let us move ahead and again talk about a connecting concept, concept number 9, that is appreciation and depreciation. So here we are talking about appreciation and depreciation of currencies. My friends, please try to understand this simple point. but an important point definitely. Assume that at present price of US dollar quoted in the spot is rupees 73. So the price quoted at spot is rupees 73 per dollar. I approach the bank and ask the bank, I would want to buy dollars after 3 months. So please mention a forward rate. Bank mentions a forward rate of rupees 74 per dollar. The spot rate is rupees 73 per dollar. The quoted forward rate for 3 months is rupees 74 per dollar. That means if I have to buy dollars, definitely not in the spot. If I have to buy dollars in the forward market, I have to pay something more than what it is prevailing now. So mentioned rate by the bank, the rate which is mentioned by the bank, if you observe, spot rate is $1 equals to rupees 73, 3-month forward rate is $1 equals to rupees 74. So 3-month forward rate, if you look into, it is higher than spot rate. It indicates that the worth of dollar is expected to rise after 3 months. That is why bank is charging rupees 74 per dollar for that forward rate. So what we are trying to convey is, when you have to identify which currency in the exchange rate, or I would say in the forex market, which currency is appreciating or which currency is depreciating, it is very simple. Identify two factors, the spot rate of that currency and the forward rate of that currency. In our example, we are considering rate of dollar quoted by bank in the spot and 3-month forward. So I just mentioned spot rate is US dollar 1 equals to Indian rupee 73 and 3-month forward rate is US dollar 1 equals to INR 74. What do we find? Over 3 months time, the price of dollar is expected to rise from 73 to 74. We would say dollar is appreciating in the forward market, or in other words, dollar is quoted at premium in the forward market. I believe you people are trying to understand what I just conveyed. So dollar is appreciating in the forward market, and when dollar is appreciating, it is appreciating against which currency, that also is worth mentioning. So the right way to mention that point would be, dollar is found to appreciate against Indian rupee. In other words, Indian rupee is found to depreciate against US dollar. We would then conclude, if the price of dollar is rising, I repeat, if the price of dollar is rising in the forward market, we would say that dollar is quoted at premium in the forward market, and we could also conclude that rupee is quoted at discount in the forward market. Friends, whatever I have just mentioned, I am summarizing the same thing on screen. Please pay attention. So what we just discussed, forward rate higher than spot rate, if this is the condition that prevails, we would say quoted currency is considered to appreciate. So in order to find whether a currency is appreciating against the other or depreciating against the other, you would just look into comparison between the spot rate and forward rate. So what we compare and conclude, if forward rate is higher than the spot rate, the quoted currency, remember that thing very well, the quoted currency is considered to appreciate, and if the forward rate is lower than the spot rate, the quoted currency is considered to depreciate. Now, this is the fundamental ground, but let us understand this by examples. So let us take an example. Spot rate is given as USD 1 equals to INR 63.60 and forward rate is given as USD 1 equals to INR 64.20. First of all, this quote is given for not Indian rupee, but the quote is given for US dollar. Why? Because this quote is given for 1 unit of US dollar, correct? In such case, if dollar's price is INR 63.60 at the spot and dollar's price is INR 64.20 as a forward rate, what do we find? price of dollar in the forward rate is higher than the spot rate, or in simple words, this forward rate is greater than or higher than the spot rate. In that case, the quoted currency, that is US dollar, will be considered to appreciate, and the other currency, that is Indian rupee, is considered to depreciate. So I told you 1 minute back, the right way would be to mention that US dollar is appreciating against Indian rupee and Indian rupee is depreciating against US dollar. We would also mention that in the forward market, US dollar is quoted at premium and Indian rupee is quoted at discount. Obviously, if dollar is appreciating, rupee will depreciate, and same way, if dollar is quoted at premium in the forward market, it is an obvious fact that rupee will be quoted at discount in the forward market. Let us write down all the observations that we made just now from this example. So it is observed that dollar is appreciating against rupee. Obviously, rupee is depreciating against dollar. Dollar is quoted at premium in the forward market and rupee is quoted at discount in the forward market. Alright friends, let us move ahead and deal with the connecting concept, that is concept number 10, premium and discount rates. Let us again begin with an example. Spot rate is given as USD 1 equals to INR 64 and forward rate for 1 year is given as USD 1 equals to INR 68. Let us see what do we observe from this. The spot rate of dollar is INR 64 and 1 year forward rate of dollar is INR 68. So the first observation, we find that US dollar is appreciating against Indian rupee. So obviously Indian rupee is depreciating against US dollar. Exactly what we concluded in the earlier example. Same thing happening over here. So obvious connecting point would be USD is quoted at premium in the forward market. So this is the spot rate, this is the forward rate. As the forward rate is higher than spot rate, we conclude that USD, the quote is given for USD. So we would say USD is quoted at premium in the forward market. So obviously INR will be quoted at discount in the forward market. Now we can definitely find out what is quoted at premium and what is quoted at discount in the forward market. But if I ask you to find out at what premium rate USD is quoted in forward market or at what discount rate INR is quoted in forward market, this will require a systematic approach of making such calculations about premium rates and discount rates, or you may also call these rates as appreciation rates and depreciation rates. So how to make that calculation, we will understand through extension of this example. In fact, in your textbook, one of the question is exactly asking you to do the same thing. So take up question number 15. In this question, see what is given. Spot rate is $1 equals to rupees 64. 1 year forward rate is $1 equals to rupees 68. Determine which currency appreciates and which one depreciates. Also determine the percentage of appreciation and depreciation. So friends, it's the same example. We have already discussed the earlier part that it is US dollar which is found to appreciate and Indian rupee which is found to depreciate. The objective now is to deal with this point. How would you determine the percentage of appreciation or depreciation, also known as premium rate and discount rate? Let us first talk about the appreciation rate of US dollar. For that, just compare the price of dollar now and price of dollar after 1 year. So the price of dollar right now is 64. It is expected that the price of dollar will become rupees 68 after 1 year. Why it is expected? Because the quoted forward rate indicates the same. So 64 is going to become 68. The increase will be by rupees 4, correct? So rupees 4 is the amount of increase and the base price of dollar is 64. So So if I would want to know the percentage increase over 1 year time, it will be difference, that is rupees 4 divided by the base price, that is 64, correct? And once you do that, you get to know that 4 divided by 64 into 100, the appreciation of dollar is by 6.25% per annum. Friends, over here I will be giving you a proper detailed explanatory solution in the first instance. I would then want you to write up that whole solution, and in examination certainly you will not be required to write up that detailed solution, and I'll show you how to present the solution from examination viewpoint as a shortcut calculation. So let us see how to present the solution. Based on the given rates, it is understood that to buy a dollar after 1 year, one has to pay more amount of rupee. Therefore, dollar is found to be appreciating and rupee is found to depreciate. So what we would say is, today's price of dollar, that is rupees 64, is expected to become rupees 68 over 1 year. The price of dollar has increased by rupees 4 on the base price of 64. So the increase is by 4 and the base price, which indicates the spot rate, is 64. So 4 is what percentage of 64 is what you have to find. Simply 4 by 64 into 100 would give you 6.25%. So we would say the price of dollar has increased by 6.25% over 1 year. Alright, let us move ahead. We may write up the same thing by applying a formula. Appreciation rate of foreign currency with respect to direct quote would be F minus S divided by S. F stands for forward rate and S stands for spot rate. So it will be 68 minus 64 divided by 64. You will be getting the same result, that is 6.25%. Now friends, in the first part we have concluded that price of dollar is increasing by 6.25%, which indicates appreciation rate of dollar or premium rate of dollar in the forward market. So if dollar is appreciating, definitely rupee is depreciating. But my friends, rupee does not depreciate by 6.25%. So let us see what would be the depreciation rate of rupee. So we write up further, if dollar has appreciated by 6.25%, that does not mean the rupee has depreciated by 6.25%. Rupee has depreciated definitely, but not by 6.25%. It would have depreciated by some other rate. How to determine that rate? I'll be showing you in a while. Let us move ahead and do the later part of the calculation, that is to determine the depreciation rate of rupee. So what we would first say is, to determine the depreciation rate of rupee, rupee should behave like a commodity in the exchange rate. In other words, indirect quote for rupee and dollar should be established. So indirect quote would be found by taking inverse of the given direct quotes. So what we would first do is, spot rate was given as $1 equals to 64. So spot rate of rupee will be $1 by 64, that is $0.015625, and 1 year forward rate would be inverse of 68, that will be $0.014706. So now look into one thing what we have got. We have got the value of rupee 1 in today's terms, and we have got value of rupee 1 year forward. And what we find, this is the value of rupee 1 today, and this is the value of rupee 1 expected after 1 year. And we find that this expected value after 1 year is less than the spot value of rupee. As a result, rupee is definitely depreciating. So we would write the worth of a rupee has reduced by 0.000919. So this is the reduction in the value of rupee on the base value of 0.015625. So the percentage reduction would be 0.0588, that is 5.88%. This is how you would determine the depreciation rate of rupee or the discount rate of rupee. So friends, I told you such detailed solution need not be presented in examination. For examination reference, I'll give you a quick way of presenting the same. Now let me give you just another alternative way of presenting the calculations. So write up that also. So alternative calculations, if depreciation rate of local currency has to be determined through a direct quote, the depreciation rate will be F minus S divided by F, that is forward minus spot divided by forward, and what you get is 5.88%. Alright friends, let us move ahead and let us see how to apply straightforward calculations that will be required in examination. So, in a question like this, appreciation or premium rate of USD can be determined by simply taking 68 minus 64 divided by 64 into 100, and what you get is 6.25%. Observe one thing, in this calculation, the numerator part, it is 68 minus 64. You would write a small explanation for your understanding, that is numerator will always be difference between spot and forward, and then the denominator has to be taken care of. The denominator will be spot. So why spot? You understand one thing, you are trying to compute the premium rate of USD, and look into one thing, the quote is also of USD. The quote is of USD and you are calculating premium rate also for USD. Therefore, denominator will be taken always as a spot because quote is for USD and premium is being determined for USD. Friends, numerator will always be difference between spot and forward irrespective of what calculation you are making. But denominator, you have to use your brains. You are computing premium rate of USD, look into the quote given, quote is given for USD, as a result you will take spot. Alright friends, let us move ahead, and what we get now is the later part, that is depreciation or discount rate of INR. You would continue to have the numerator as same, that is difference between the spot and forward, so it will be still 68 minus 64. Look into one thing, the denominator what we have taken now is not the spot rate, it is forward rate. So what you get is 5.88% per annum. So what is the explanation for the numerator? Same thing, right? You would write numerator will always be difference between spot and forward, and denominator this time you have not taken as spot, denominator is forward. Reason is very simple, denominator is forward because quote is for USD and discount is being determined for INR. Friends, let me tell you one thing. The logical approach of making this calculation I have done through indirect quotes that I have shown you earlier. Now this is a shortcut approach. I want you people to write up an answer like this in examination whenever a question comes.